Most people believe investing is complicated. They believe it requires constant analysis, predictions, intelligence, or access to information others do not have. But long-term wealth has historically been built in a much simpler way. Not through stock picking, not through market timing, not through prediction, through ownership. Broad ownership of productive businesses over long periods of time. When you buy a broad index fund, you are not betting on one company. You are buying a small piece of hundreds, sometimes thousands, of businesses at once. Instead of asking, which company will win, you are saying, I believe businesses collectively will grow over time. That shift changes everything. Markets are competitive systems. Every stock price reflects the combined expectations of millions of investors, professionals, institutions, analysts. Trying to consistently outsmart that system is extremely difficult and often expensive. High turnover, higher fees, emotional decisions. Index investing removes that pressure. It accepts the market return. And historically, the market return has been enough. Not spectacular every year, but powerful over decades. One of the most overlooked factors in investing is cost. If a fund charges high fees, those fees reduce your return every single year. It may seem small. 1% does not feel dramatic. But over 30 years, that 1% compounds against you. Low-cost index funds minimize that drag, which means more of the return stays with you. And over long periods, controlling cost can matter more than trying to pick winners. The philosophy is simple. Wide diversification, low cost, long-term holding, not speculation. But philosophy alone is not enough. There is also structure. Compounding works both ways. If someone carries high-interest debt, especially credit cards or personal loans, the first priority is eliminating that debt. The interest charged there then often grows faster than investments realistically can. In that case, repayment is not just responsible, it is mathematically efficient. Once high-interest debt is cleared, the next layer is stability. An emergency fund, typically covering 3 to 6 months of essential expenses, creates a buffer. Life is unpredictable. Income can pause, expenses can rise. Without a buffer, investments are often sold at the worst possible time. Stability protects compounding. After that foundation is built, investing becomes a process, not an event. A practical framework many people follow is directing 10 to 15% or more of monthly net income into broad, low-cost index funds. Not occasionally, not when motivated. Every month. Invest first. Spend what remains. When life happens, and it always does, the emergency fund absorbs the shock. The car breaks down. A job is lost. An unexpected medical expense appears. A family member needs support. Income pauses, but expenses do not. In those moments, the emergency fund becomes stability. It protects your investments from being sold at the worst possible time. The investment account remains untouched because compounding needs time, and time needs protection. With that safety net in place, the real work begins. And here's the truth. It is far simpler than the experts would have you believe. Investing becomes a process, not an event. Imagine you decide to invest a few hundred every month. Not because you can predict markets, but because you've decided this is what you do. Let's say it's $300 a month. You set it up. It leaves your account automatically. You don't negotiate with it. You don't debate it. You just let it happen. Over 25 years, with average market returns around 7%, That quiet habit grows to roughly 230,000. Now suppose your income grows and you increase it to 500 per month. Same strategy, same index fund, same boring routine. Over that same 25-year stretch, it grows to around 380,000. Nothing fancy happened. You didn't switch funds. You didn't outsmart anyone. You simply owned the market and gave it time. Now stretch the timeline to 30 years. 300 per month moves toward 360,000. 500 per month moves past 600,000. Notice what's doing the heavy lifting. Not genius, not effort, not intensity, time. And the decision to stay the course. That's the part most people underestimate. They focus on picking the perfect investment. But the real power is in picking a simple one and refusing to interrupt it. Compounding isn't dramatic. It's stubborn. Index investing also removes ego from the equation. You are not trying to prove you are smarter than the market. You are accepting the collective growth of global productivity. It is a humble strategy. But humility compounds. This approach does not promise quick wealth. It does not guarantee smooth returns. Markets will fall, sometimes significantly. But broad ownership has historically recovered over long horizons. The key is staying invested. If someone invests consistently for 5 years, they build a habit. If they invest for 15 years, they build momentum. If they invest for 30 years, they build transformation. Time multiplies discipline. The simple path is rarely exciting. It does not generate headlines. It does not feel impressive in the moment. But it has built financial independence for countless ordinary investors. Not because they were brilliant, but because they were consistent. Own broadly. Invest regularly. Keep costs low. Think long-term, and allow compounding to quietly reward patience. Investing is not about being brilliant. It is not about timing the market, or following the hot tip, or trying to beat the other guy. Investing is about one thing: discipline. Most folks make it far too complicated. They look for excitement. They chase the next big thing. But the most successful strategy is usually the most boring one. If you have a sound, low-cost investment, something that simply captures the progress of the world, your only job is to leave it alone. The biggest risk to your wealth is not the market itself. It is your temperament. It is the urge to do something when you should be doing absolutely nothing. Most people fail for a simple reason. They get bored. They get impatient. They want to get rich, fast. But the world is run by people who are content to get rich slowly. So simplify your life. Automate your savings. Buy a broad index of the world's businesses and hold them for a lifetime. When markets swing wildly, when headlines scream panic, when everyone around you is losing their nerve, keep your head. Because if you can remain steady while others react emotionally, you will discover something powerful. The boring path is the only one that truly leads to freedom. Do not interrupt the miracle. Just let it grow.